Okay, well, welcome everyone this evening to Break of Day Capital's webinar, Debunking Multifamily Myths Part 2. To those of us who joined us 2 weeks ago, welcome back. And to those of you who did not, who are joining us tonight, do not worry. Joe is going to do a recap of last week's first five on this multifamily. So tonight during our webinar, a couple things we want to stress is questions. At any point you have a question tonight, please type it in the Q&A box, not the chat box, the Q&A box. This webinar, Joe and I are going to wait to the very end to answer questions. But at any point you have a question, please go ahead and type it in the Q&A box. And always want to remind people too, a lot of people often, when I'm speaking with them, say, I have a silly question, I have a stupid question. No, you don't. You have a question. So please, any question you have, Jill and I would love to answer it. Difficult questions too, please. Anything that's on your mind, please ask us. We're here to answer your questions. So don't worry, not going to read this in its entirety, but we do have to just put these our disclaimers on the screen, the confidentiality one, and the next one, which is the financial disclaimer. So just have to put this on the screen. We're not going to read it to you word by word. So those of you who are, not familiar with Break of Day Capital, our CEO is Gary Lipsky. He's our founder CEO. Other terms you often heard referred to the CEO and founder are sponsor and operator. All those terms are interchangeable. And I always start talking about Gary Lipsky and Break of Day Capital's team first, because those of you who have not invested in multifamily real estate before, I tell everyone, no matter how new they are to multifamily or if they're very experienced, always you want to do your due diligence on the CEO and his team first, the deal second. So with that, Gary Lipsky, he has been doing real estate investing since 2002, so over 2 decades of experience. He is a serial entrepreneur. He founded a company that grew to over 12 million in revenue and had 700 plus employees and helped 9,000 students on a daily basis. He has written an Amazon best-selling book called Best in Class. Highly recommend you purchase, or not purchase, but go to our webpage, breakofdaycapital.com, where you can order the book. It's free, just have to pay for shipping. Excellent read about the asset management part of the multifamily business. And he's also very philanthropic. He's a founding board member of the not-for-profit Core Educational Services. Joe and I, your co-hosts for tonight. Joe, my colleague, if you have not connected with him yet on LinkedIn, I highly recommend you do so. If you have your phone handy, you can just scan that QR code and connect with him that way. Or you can just search his name. His contact information on the left side of your screen, Joseph at breakofdaycapital.com, and his number's underneath there as well. And Joe has been actively investing in real estate for quite some time. He has invested, and you're reading that correctly, over 50 commercial real estate syndications and across various different types of commercial real estate, not just multifamily. He has invested in over 6 deals with Break of Day Capital before he officially joined the team in 2022. And prior to focusing on real estate full-time, Joe worked in the investment management business. He spent 5 years at a hedge fund in New York City, and then 7 years at a large institutional fund manager in Los Angeles. And Joe loves what he does. He loves conversing with all types of investors and has a deep interest and love of macroeconomics, real estate, alternative investments like crypto, and also health. So same with Joe. If you've not connected with me yet on LinkedIn and your phone's handy, please scan that QR code and connect with me. You also can connect with me. My email is adam@breakofdaycapital.com. And my number's right underneath that too. You can call or text me at that number, 602-529-2056. And don't worry, Joe and I will give our information at the conclusion tonight as well. But like Joe, my background is Wall Street. I spent over 20 years on Wall Street. I was on the other end of the phone, though. I was on the sell side. I covered some of the largest and best performing hedge funds and mutual funds and family offices, talked about stock ideas, hedging strategies. And just before I joined Break of Day Capital, I was a multifamily realtor in Arizona. I did deals throughout the state, mostly Phoenix and Tucson. And like Joe, I love what I do. I love building connections with investors and helping them achieve their financial objectives through real estate investing. So as I said tonight, please, at any point you have a question, just type it in the box. Now, Break of Day Capital, what do we do? What we're focused on is acquiring underperforming multifamily properties in growth markets. We're focused on the Southwest specifically. And once we acquire a property, we implement strong repositioning strategies and best-in-class asset management to maximize value for the shareholders. In 2023, we are recognized by the American Apartment Owners Association, the AAOA, which has over 140,000 members, as the best real estate syndication company of 2022. Inc. magazine recognized us as in 2023 as the 671st fastest growing private company and the 25th fastest growing real estate company. We've acquired over 1,600 units with over 280 million in real estate transactions. And of the deals we've done, four have gone full cycle. We've purchased them, renovated, stabilized, and sold. And in each case, and some were in a bull market, some were in a bear market, the returns far exceeded projections. Now, talking about the asset management part of the business, not just has Gary written a best-selling book called Best in Class, he also hosts a weekly podcast. Joe and I have both been guests on the podcast, The Real Estate Investor. Either if you have an iPhone and it's under podcast, wherever you get your podcast, if you just type in Break of Day Capital or Gary Lipsky, it'll show up and you can subscribe to the podcast. But asset management is something that a lot of syndicators aren't as focused on as they should be. A lot of them are much more focused on acquisitions, capital raise. That's what they talk about. And they look at asset management as just really maintenance. When it's one of the most important parts of the business. That's really where you shine, the asset management part. So that is something that we constantly are focused on. And as I said, I highly recommend you check out his book and the podcast. And what we have a bullet at the bottom there too is, due to best-in-class asset management and our expertise, we've been able to boost the bottom line, the net operating income of 9 consecutive properties over 40% within the first 12 months. That is a tremendous number. And not only have we accomplished it for 9 consecutive deals, the last deal we just did, Spanish Trail, that deal's outperforming right now too. So most likely it's going to be 10 deals in a row. So Break a Day Capital's team, not going to go into everybody's bio and specifics, but I do believe that the old saying that you're the average of the 5 people you spend the most amount of time with. And we have a phenomenal team. I have worked on many places on Wall Street, a couple real estate places. I can tell you that this is by far and away the best team I've ever been a part of. Mission. Break a Day Capital's mission, right here, when it comes to mission and core values, when you're looking at a company's like pitch deck and their webpage, mission and core values is something I find most people kind of glance at or they don't really dive into or ask about. But this is extremely important. I found when I worked at other places where there hasn't been a mission statement and they haven't had their core values laid out in front of people to look at, the places have actually, lacked this. And it's often, I've seen these places really implode. So our mission is to provide passive investors with superior risk-adjusted returns with the highest level of transparency and fiduciary responsibility while improving the quality of life and community of our residents. That is our mission. And the core values attached to that are integrity, transparency, communication, diligence, and Kaizen. Kaizen is the one term of those five that I get a lot of questions about, like what exactly does that mean, or what is that? People are not really familiar with that term as much, but it's a Japanese business term. It talks about constantly striving and looking to improve yourself and the team, and that's something that we all really believe in at Break of Day Capital. There's a lot of little adjustments you can make in your day or what you do can make a huge difference. And we really believe in that. We always strive to improve each other and ourselves. So at this point, I'm going to turn the presentation over to my colleague, Joseph Fang. He is going to do a recap of last week's, the 5 myths we went over last week. And he's also then going to go over myths number 6, 7, and 8. I'm going to do 9 and 10 before we open up to questions. A reminder, as I said before, at any point you have a question, please go ahead and type it into the chat. Last week we did something new. We decided to put in a couple trivia questions. And last week's our first question was about Gary Lipsky. What TV show was he used as was his name a character on? So tonight this is our first question of the night. Joe Fang not only is invested in numerous commercial real estate deals, he has invested in a restaurant. And the restaurant's in Hawthorne, California. Any of you are local to that area, you should definitely check it out. But here are choices of what is the name of the restaurant: Sticky Noodles, Chubby Rice, Rice is Life, or Let's Noodle. This question is not going to be open. I'm just going to leave this open for about another 30 seconds or so. So please just click the answer that you think it is. And at the conclusion, when we do the question and answer part of tonight's webinar, we are going to reveal the answers. So again, don't be shy. Please click whatever you think is the correct answer. Going to leave this open for about 10 more seconds. So please go ahead and click your answer, what you think is the right answer. Okay. Gonna have to close it now. All right, last chance.
All right, Adam, thanks for that awesome intro and a little bit about our company background. Before we do the part 2 of this webinar series, let me just quickly go over the 5 myths that we talked about, the sort of the part 1 in this series that we did a couple of weeks ago. Now, if you don't have a recording of this, for some reason you didn't attend, or you don't have a recording, it is on our website. Or if you want to reach out to either Adam or myself, we'll be happy to send you a link. And if you want to have a discussion, we're always here for you. Okay, myth number 1: always use long-term fixed rate debt. So the fact the truth of the matter there is that there's really no one loan product that is superior. There's everything from agency, long-term fixed rate to floating to bridge. There's just a variety of different types of loans. There's mezz, there's pref, and it really just, the point that we were trying to make there is that there's no one debt that is superior. So you really just need to analyze, making sure that whatever the type of debt that's being used is suitable for the particular business plan, for the investment strategy. Myth number 2 was not underwriting properly to account for the recent rate hike. So I see this a lot on social media that, over the last, 16, 18 months, we basically had rates get close to zero. And then basically, the Fed panicked and then went the other way and got the rates back up to, 5.5, 5.25, 5.5. And so I see people posting on social media, oh, if you had just used fixed rate debt, you wouldn't have this problem. But the thing is that a couple issues there is that when people talk about using long-term fixed rate debt, they often do not also give you the disclaimer, which is that unlike traditional 30-year mortgages that you have in single family residential, there is no 30-year fixed mortgages in commercial real estate without prepayment penalty. So the longer you go out, the longer you fix the rate, the longer the maturity, the higher the prepayment penalty, and it's pretty steep. It's often in the millions. Um, and so that again may not be appropriate for for whatever the strategy that you're going after. The other thing that we mentioned with regards to myth number two was rather than deciding whether a deal is good or not based on the type of debt that's being used, it's again more important to vet the sponsor to look at their track record to see to assess their ability to execute on this business strategy and maybe look for additional things like are they setting aside extra cash or extra reserves for the various components of the property, like the roof, the HVAC system, the plumbing, um, maybe the foundation. It just a prudent operator will set aside additional rent reserves to account for those things, as well as keeping extra liquidity, not only for the asset itself, but also at the corporate level, because we do our best, to try to underwrite, try to foresee every unforeseen circumstance. Um, but we're not magicians, we still have to work with what the market gives us, right? And so really the way to ride out any unforeseen issues is really just to have a lot of cash on hand. And finally, if you were going to underwrite, to a 5.5% rate hike, you would never buy a deal. Your spreadsheet would just basically blow up. I mean, that's the truth. Okay. Myth number three. Again, I see this a lot. I see this on YouTube all the time. Maybe it's clickbait. It works, right? People like fear sells. But there's no, I've been doing this for a long time. There's no, real estate is not one market. It's not like the stock market, right? It's highly fragmented. How many times have you heard real estate market is, super localized, it's hyper localized. And so every market's going to be a little different. It has its own fundamentals. It has its own supply and demand dynamics, and even, within a submarket, you could have one property that's doing really well and another property that's completely mismanaged and, and therefore it could be a potential value add opportunity. Myth number four is something similar to myth number three, which is, again, this is clickbaity stuff, commercial real estate is crashing. Well, commercial real estate encompasses a lot of different asset types. You've got hotels, you've got office, you've got multifamily, and even within multifamily, you have luxury stuff, you have workforce housing, you have stuff in the ghetto, so it's kind of, you really have to narrow down to the actual the actual asset type. During COVID, it was hotels that were getting killed, and then really the big stuff right now is the distress in an office, and we're not really seeing that in multifamily. It's just more of some of the stress that we're seeing in multifamily is more from people not putting on the operators not putting on the right type of debt. But the asset itself is for the most part doing pretty well. Okay, and then just to close it off, myth number five, and I see this all the time. Higher cap rates are better than lower cap rates. Well, that's not necessarily true. It just really depends on what you're talking about. Just for those who don't know what a cap rate is, it's really just how much the property makes versus its value, divided by its value. So a six cap, something that has a six cap rate just means that if it's $1 million property, it gives you $60,000 of income, not taking into consideration debt, right? So if you see a property that is a six cap versus another property that's a four cap, it doesn't necessarily tell you that one is a better deal than the other because there are many different ways to calculate, not calculate, there are different ways to represent what the cap rate is. There's a going in cap rate, there's the pro forma cap rate, there's a cap rate based on the T3, based on the T12, and those mean the trailing 3 months, the trailing 12 months, you know, so you can even have different cap rates in different markets, right? It's just kind of like it's really like kind of similar to the PE multiple of a stock. You know that growth stocks are going to have a higher PE multiple and a value stock's going to have a lower PE multiple. So one market could have a lower cap rate, and another market can have a higher cap rate, but that doesn't mean that the higher cap rate is a better market than a lower cap rate market. So that's some of the things that we talked about in the last presentation. All right. Myth number 6. This is another one that I hear all the time. In-house property management is better than third-party property management. So what's the what are the facts? Again, this is not something that one is always better, than the other way. It's just really depends on the operator and their relationship with their property management company. But let's talk about some of the pros and cons of both, and then hopefully this will help you evaluate just kind of understanding the nuances. But one of the better things about having in-house property management being vertically integrated is that you have tighter control over the staff. You also have more control over the accounting, right? Because you're gonna want stuff reported the way that you like it, right? So those are the pros of having in-house property management. But there are also cons. How many properties do we have, Adam? We're what, 9, 10? I lose track because we're buying and selling, but let's say if we have 10 properties and 150 to 250 units, that's a lot of units, right? And so on on any one of these properties, we could have anywhere from 2 to 5, property managers on site, right? So you multiply all this number, the next thing that you're dealing with is managing 50 other people, and it's we want Gary, the team out there looking for good deals, not spend all their time, all of our time just dealing with HR issues, which is really what it comes. The reality of having a large team is that you're gonna have to be dealing, you're gonna spend a lot of your time firing and hiring people, and it's just and there's a lot of attrition, in the property management business. Anybody who's been a long time real estate investor will tell you, property management is a thankless job. Okay, the pros of a third property management company. Um, well, especially when you're dealing with an institutional grade, somebody who's got the scale, who's been around for a long time, you're going to have access to their professionally trained staff. If somebody calls in sick or they leave, the property managers get poached, by another operator, they have backup staff. They can pull somebody off another property, so they can handle all the HR issues that frankly, we don't want to be dealing with. Um, One of the other things that we really like is that, like, when we're looking at buying a deal, um, Gary and our asset manager, or I should say our acquisition manager, would basically produce a pro forma financials, for the for the prospective property. We start to underwrite what we think this property is going to do. So we have certain parameters, we're basing our estimates on a variety of research, right? From RealPage, Yardi Matrix, Coinstar, et cetera, et cetera. And um, having a third property manager, especially like somebody that one of the companies that we work with, who's been in Tucson for 40, 50 years, and they know that market so well. Um, they're going to be able to give us data that's not captured on RealPage. And we ask them to come up with a set of performance, and then we will compare and contrast. So it's kind of like we're leveraging off of their experience to kind of tell us where we're right and where we're wrong, or if there's a difference of opinion, why is that? So we can learn a lot more about the property. Also, a lot of these well, maybe not a lot, but some of these better property management companies have extensive relationship with vendors, and then we could leverage off of that relationship to get volume discounting, to get better service, when we do renovations on our units. And so, based on our years of experience, what we found that works for us is that if we're partnered with an institutional grade third-party property management company who specializes in the area, who knows the market really well, um, and they also specialize in the particular asset type that we buy, which is the Class B and C stuff. Um, and having a good working relationship, being one of their valued, operators, we actually find this happy medium where we can leverage all the things that they're good at, but we supplement the things that they're not, perhaps, not that they're bad at it, but that maybe they're not as efficient at, and we would come in and supplement the things that maybe they're inadequate in. And this is why Gary focuses so much on asset management. That's the piece that hardly anybody talks about. And that's the piece where you're working closely with your boots on the ground, the people who are, facing the tenants, and, collecting rent checks, attending to service calls, the people who are executing your business plan, who's doing your renovations, that part, we're very intimately involved with them. And so we make sure that things go smoothly. Okay. Myth number 7, a deal must have positive leverage to be good. And just in case you don't know what the concept positive leverage means, it simply means this. Earlier I mentioned that one way to value commercial real estate is to look at, actually, it's really the one of the most poor ways is to look at the cap rate, right? Which, again, I'll tell you that it's the income, the net operating income divided by the property value, okay, without using any leverage, and you get a number. So in the early example, I use $1 million property value. You get $60,000 a month, a year, net of the operating expenses, and that's a 6 cap, right? Well, um, we know that, and I'm sure a lot of you guys know that uh, leverage debt is really well suited for real estate because real estate prices don't fluctuate on a second by second basis. So putting on leverage is a great way to enhance the returns of the property. Well, what positive leverage means is that when you're putting on debt, when you're putting on leverage, if the interest rate is lower than your cap rate, okay? So let's say in the early example, we have a 6% cap rate, but your interest payment or your interest rate is only 5. The cap rate is higher than the interest rate. Therefore, it has positive leverage, meaning that when you're adding leverage, when you're putting on debt, you're borrowing at a lower cost, but you're earning a higher yield. Okay, so you have this positive reinforcement, so to speak. Now, this sounds great. We would love to have positive leverage every opportunity we can, but realistically, when you're buying deals, these deals are not really all that common. In fact, you know, um, we specialize in value add. Basically, what that means is we're buying properties that are mismanaged, and we're trying to do something to it, fix the management, fix maybe there's higher than expected expenses. Maybe the units are they're in poor condition, or there's a lot of deferred maintenance, or there's something that we can correct, something that we can optimize to increase the value. Um, it's 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 almost like you're buying a dog with fleas, right? And you're trying to get rid of the fleas to increase the dog's value, right? So that's basically what we do. That's what our investors pay us to do. So what I'm trying to tell you is that whether a deal has a positive leverage going in or not, that's not as critical as, once again, going back to the operator, an operator who has a successful track record and operational expertise to take a property that's misperforming, underperforming, mismanaged, and being able to do things to it towards positive leverage, right? And so what that means is maybe we might start off in the beginning where the debt is not really working for us, but there's a path where we get the positive leverage and the debt is really working for us. The leverage is really working for us. So you're creating that value, right? And so um, what I'm trying to say is that as long as the operator has a history of successful execution of that business plan to take something that might potentially start off as negative leverage into something that has positive leverage. Sometimes you'll hear people say like, oh, this operator is buying a 4 cap, but he's going to turn it into a 6 cap. Um, so you can see how that, there's a positive, there's a increase in the cap rate. And you know, I don't want to belabor this point, but that's actually not the correct way to say it. It's actually when you bring something to stabilization, it's actually called yield on cost, right? So when you increase the NOI, you're going to arrive at a higher cap rate, but we don't call that a higher cap rate. It's called yield on cost. And the difference between the yield on cost and your going in cap rate is called a development spread. And that is a metric that tells you how much value the operator is actually adding to the property. Okay. So bottom line is if there's a path to positive leverage, that's a that's a good thing. All right. This is probably one of my favorite ones. Myth number 8. It's better to hold real estate forever. Okay. Okay. So I talk to lots of investors and I get this question like 3, 4 times a week, which is, why don't you guys hold your property forever? Why don't you just keep it, do the cash out refinance because it's a tax-free transaction? Um, these deals are hard enough to come by. I mean, Adam, how long did it take us to buy Spanish Trail? Was it 14 months or 17 months? I forgot, but it was a
14
long time.
months.
So these deals are really hard to come by. So why do you want to go sell them in 3 years or 5 years, whatever your hold period is? Well, here's why. Again, this is another one of those things that people say stuff like this, but they don't tell you the flip side. It's like a half truth, right? As a long-time real estate investor, I've been through multiple cycles and things break. Okay. And especially these large multifamily, 150 plus units, they have a this capex cycle. Things break or things get outdated. And if you want to try to get top rents, you have to constantly um either renovate or um fix deferred maintenance. And it's kind of averaging like 7 years. Every you have this like 7 year cycle where you constantly have to make improvements to the property. Well, so what happens is when you hold on to the property for too long, you're gonna run into, that you're gonna hit that cycle where you're gonna have to do a lot of repairs or possibly do another round of renovations, to get up to more modern standards. And those things cost, a couple $100,000 here and $500,000 there, and pretty soon it's a few $1 million. Well, that money comes out of investors' pockets. So, it really reduces your returns if you hold on to properties for too long. Now, I get it, people want to, you know, they want to grow their wealth uh in the most tax efficient manner. And so some people don't like flipping properties, but in the next slide, we'll show you how we actually can still uh, flip properties, but also be able to take advantage of the tax benefits that come with these flips. Now, before I talk about the tax benefits, um, let me just mention one more thing, and this is another nuance point, which is a concept called velocity of money. Okay, so the reason why we love doing value add is because we are literally taking some ugly duckling on the block and you know doing executing our business plan of making improvements, right? And even a fresh coat of paint, maybe some fencing, um, even a new we could make front porches, front yards, and uh redo the landscaping. It gives the property so much, a curb appeal. Um, and what we do is because we literally make a property, we could bring a property like one or maybe a half a grade or one grade better. And with that, we could charge a few $100s more for rent, which is still very affordable. A lot of our deals, we're taking, something that's pretty old, charging $900 a month for two-bedroom, and then spending 15, $20,000 a unit renovating and making it look really modernized. And we're getting 1,200, $1,300 a month. And that bump of a few $100s increases the property value significantly. Okay. And so think of it like this. It's like if you can imagine what a hockey puck stick looks like. It starts off flat on the bottom, and you have this the handle, right? And then it kind of levels out, right? That's really what the value of our properties look like before and after we do the transformation. So you start down here, you get a rapid increase in property value, and then it kind of plateaus out. So once we hit market rates, then the property, we can't keep doing these two, $300 bumps. It's only one shot, right? One time. And then we're getting, maybe 20, $30 bumps, as with the market. And so we're trying to capture that steep increase, that rapid increase, and then to keep repeating that process, right? And that's what we mean by velocity of money is that we're trying to grow that your capital at the fastest rate possible so that over time you'll end up with a much bigger portfolio, much bigger nest egg, than if you were just to keep things at market rate and then kind of compounding at 3 to 5% instead of 30, 40% NOI. Okay. Finally, um, we we like doing these large apartment flips. It's not a 6 month flip, it's like a 3 to 5 year flip. And the reason why is that, aside from the fact that we're trying to get away from having to, keep putting a lot of money into the deal every few years, but also trying to grow on money as quickly as possible. But there is a way to defer uh, the taxable gains. Um, there's a concept that a lot of CPAs put out there, a lot of real estate savvy CPAs put out there. It's called the lazy 1031. So unlike a traditional 1031, which I'm sure many of you have heard of, which is that when you sell a property, the gains have to be exchanged into another property, but you only have a certain amount of time to get that to identify the exchange property, and you only have a very limited time to to close on those properties. And so what ends up happening is that the exchange buyer, the exchanger, sometimes pressed for time, would actually end up being forced into doing not a into a not so good deal, right? I often joke the reason why you're selling your property is because you're able to sell high. But then, if you're forced to do an exchange that you might not like, well, guess what? You're buying higher, right? So it's not ideal. And however, using these syndications, you can actually execute a lazy 1031, which is that in the same taxable year that you're exiting a deal, as long as you invest enough proceeds into your future deal in the same year, then you could take the accelerated depreciation, and then we currently still have bonus depreciation. And if all that stuff throws you off, just give Adam or myself a call, and we'll happily walk you through the math. But you could take accelerated depreciation from doing a cost segregation study, and then supercharging it with bonus depreciation that's available today. And you could potentially have enough write-offs from the future deal to offset the capital gains, the depreciation recapture from the deal that you're exiting. So in a way, it's like you're performing a 1031, but you have a whole year to do it. And so you're not under the gun to do a bad deal. Okay. Oh, that was a mouthful. Okay, with that, let me turn the presentation back over to Adam, and I'm gonna take a little break.
Well, thank you, Joe. That was outstanding. I really liked your explanation of myth 8 about holding real estate forever. That's a question I get asked quite a bit. So I told you there's going to be, before I get into myth 9 and 10, I said there's going to be two trivia questions tonight. So the second question we're asking tonight is about tenants. How long does the average tenant stay in apartment? 25.3 months, 27.5 months, 33.1 month, or 34.8 months. So just click on what you think is the correct answer, and we will, as I said, when we get to the Q&A, we're going to reveal the answers to both of tonight's trivia. What you think is the correct answer. And I want to remind you tonight too, at any point you have a question, please go ahead and type it into the Q&A section. As I said, we're going to get to this at the conclusion of after myth 10. We're going to get into the question and answers. So please have your questions ready. Okay, I'm gonna have to end it here if you haven't clicked in your answer. So myth number 9, early and consistent distributions mean the operator is superior. Now, when you're looking at, often when you're looking at a new deal, the pitch deck, they should have laid out, when they expect to give distributions, what they're hoping to accomplish with an equity multiple, the returns. And often though, in these pitch decks, some of these operators will say that they expect to start giving distributions immediately. So they're acquiring a value add property and saying, we're going to start giving you distributions literally from the first quarter where they've acquired, since they acquired a property. And usually often at a very high rate. The preferred rates, the hurdle that an operator has to achieve in order to share in the profits. Now, when you see this, to me, it is a giant red flag, something that I'm very weary of. It does not mean that the operator is superior by any means. They're usually giving a very artificial comfort, since when you acquire value add property, there's a lot of work that needs to be done. So when you see this, when you see a value add deal and the operator is already advertising, we're going to start giving you distributions from the first quarter, and then consistently expects them to uptick, that what that usually means is that the operator has raised additional capital than they needed, and that's where they're paying the distributions from. So as we say there, yes, they're paying investors with their own capital in that case. What you want to see is an operator paying from the operating income, not from reserves. And one way you can check this is at the financial statements. There should be enough income for distributions if they're paying them. And as before, as I said, one of our core values is transparency. We update the financials to the investor portal on every deal on a quarterly basis. And we also give monthly updates of how the property is doing. So we provide the financials, and operators should do that. Now, so an experienced value-add investor, when they acquire one of these properties, they know that it's a lot less stable in the beginning because for a value-add property, there's usually renovations that need to be done, and you're creating value, you're cutting expenses. There's usually a bit higher of a turnover when the units are vacant. It's when the renovations happen, so the unit might sit vacant for a month or two to achieve those higher rents. So the first year of a property, when someone acquires it, it's highly unlikely that there's going to be enough rental income early on to make any meaningful distribution immediately or consistently. And that's what you want to see when you're investing in a value add property. Really, as I tell everybody, is your goal is you want to get the big payday at the very end. So distributions is not something that you really should be focused on. And I'd be wary if any sponsor saying we're going to give you consistent distribution starting from the first quarter. Attached to that too is when you own any type of real estate, think about if you own your home. I mean, how many things have gone wrong? Plumbing issues, roof issues. With multifamily, the unexpected happens. There could be something that you did not forecast. As I said, plumbing, roofing. And when that happens too, a lot of these operators who have promised steady distributions will, take money out of reserves to pay those distributions when there's a big expense. When a superior, good operator with experience will know not to. Now, if any of our properties, something unexpected happened, we would send in our monthly newsletter, hey, guess what? Unfortunately, this happened, but we're going to halt distributions for a little while. We're going to use the money right now to repair the roof, the plumbing, whatever needed to be done. And once that's completed, we're going to start the distributions up again. That has no impact on should have no impact on your return because, as I said, with multifamily, the big upside is when the property is sold at the end. That's where you're going to see the big upside, not the distributions. They're a plus, but they're not, the key thing to be focused on. And, one thing as I said, Joe and I have a Wall Street background. One thing I use a comparison, I remind people who are new to multifamily is when think of some of the best performing stocks out there, Berkshire Hathaway, NVIDIA. Berkshire Hathaway doesn't pay dividends. NVIDIA pays such a minuscule dividend, it's not even relevant. You own them because of the big upside you're getting. And that's really the mindset you should have when it comes to a multifamily property. Distributions are a plus, but they're not something to be too focused on. And when you're seeing them, as I said, right out of the gate, distributions, be very wary. Most of the time, that means he is giving distributions out of investors' money, not operating income. Distributions should never be paid out of reserves. Reserves are there for unexpected expenses. They should only be coming out of operating income. And a sponsor should be providing the financials for you to be checking that out. So myth number 10, this time is different. That is a term I have heard my entire career, Wall Street real estate. And I'm sure no matter what profession you're in, you've heard that said time and time again. It probably dates back, my guess would be, it probably dates back to the original bubble, the tulips in Amsterdam in the 17th century. Now, as we said here, this probably costs investors more money than anything else. But we understand, what happens. There's a great saying, that history does not always repeat, but it often rhymes. Now, most academics, or a lot of academics, don't believe in cycles, patterns that repeat. They don't believe in that. But remember, academics, they sit in their office in a university. They have no real world experience in the private sector. So should not be listening to them. Um, there's a lot of things that you can see in markets. You cannot, time them perfectly, but you also have a very good idea what's going on. And cycles provide excellent roadmaps for clues to look for along the way. Now, human psychology, things people love to say it's different this time. When I started my career in Wall Street, the dot-com bubble was happening. And I heard from a lot of people in a lot of different firms who are making a ton of money say, oh, it's different this time. It's different this time. Well, it wasn't. Things got inflated. They came crashing down. But as Joe said, we understand this because, humans are emotionally driven. We're, obviously, Warren Buffett's quote is legendary. He talks about, buying when others are buy when others are fearful, sell when others are greedy. But actually, this is something very hard to do. And there's a legendary quant investor Jim Simmons. Sadly he died, passed away about 2 weeks ago. So you probably, if you're on LinkedIn, you probably did see somebody one of your friends or somebody you're connected to, you probably talked about him in some way. And a lot of my connections did. But here was somebody who ran the greatest performing fund of all time. And it was all quant driven. It was, we're going to take human emotion out of it. But people who worked at this fund said that even though this was the best performing fund, the computer crushed it versus the markets, our performance was tremendous. There was even times that Jim Simmons called his desk, went away on vacation, said, you know what? I'm a little concerned. I think we're a little overweight this or underweight that. And his team had to say to him, no, Jim, we're going to trust the computer. And the computer was always right. But here is a legendary investor, somebody worth over $30 billion, who even he questioned, even when he tried to take emotion out of it, was not able to. And, personally, when, I was on Wall Street one time, I was there during the financial crisis. The financial stocks were in free fall. Where I had my personal bank account was at Citibank. And this was a company that about a year ago, in like 2007, 2006, was, $45, $50 a share. People were saying it's worth 80, great breakup value. Saudi Royal Prince was on TV touting. And the stock crashed $1. Out there, I mean, sure, the insurance, but really do paperwork if the bank forecloses. And guess what? That day was the absolute bottom of the market. That day, the stock rallied and only did better since then. So we are driven by human emotions. Now, talking about market cycles, it's different. It's very difficult to time the market perfectly. Going back to Warren Buffett, he's not one to ever put like a pin on a chart and say, this, I'm only going to buy the stock here, only going to sell it here. He knows when it's low, that is a good time to buy. He's not too worried about getting the absolute bottom. And the same way when he's selling the top. So while it's almost impossible to get the absolute top or bottom, people can get relatively close tracking cycles. And that's something that we do. And what's really fascinating about real estate is there is a cycle in real estate. And it's been tested and shows a cycle going back, there's a 250-year cycle that very few people are aware of. So one that's very important, knowing these cycles and knowing the market intelligence, no matter what the market is, that there are tops and there are bottoms. So it's very important to track this and know where we are in the cycles, and to ignore that, timeless phrase. This time is different, although it never truly. I found a time where he said this time is different when it actually was in fact different. So we're going to open this up to questions. So please at any time, any question you want, type in the Q&A box, not the chat box, the Q&A box, and we're going to get to your question. And as I said before, there are no silly questions. Joe and I are here to answer your question. We love challenging questions, so don't be afraid. Try to stump us as well. But before as you're typing in your question, one thing we want to announce that we're extremely, excited about is Break of Day Capital recently launched our preferred income fund. Now, this opportunity, you can reach out to us to talk more about it, but this is an excellent opportunity to have your portfolio diversified. This fund is offering or giving investors, not offering, but giving investors an 8% preferred return net of fees and expenses. You can opt to have your the 8% distributed on a monthly basis. You can also opt to have the dividends reinvested. And what I really love about this fund too is the redemption period. Most funds, when I was on Wall Street, all the hedge funds that I knew, there was a very small window to ever request your money back. It was usually, started in mid-December. It was like usually a 2-week window. And then when it came to getting your money back, it was not immediate. Sometimes it took as many as 3 months and you were not participating in the upside there as well. So we're offering, you get a 45, at any point after your money's been in the fund for 90 days, you can request your money back the first week of every month. After that window is up, your money, if you request your money, it will be returned to you in 45 days. So very excited about that. We're going to start, taking questions, but want to just remind people, my email and contact information, Adam at Break of Day Capital. My number is right there too, 602-529-2056. You can call or text me at that number. And we can also we can book a discovery call to go over your goals and to go over our investment opportunities in further detail. Our entire team here is to answer any of your questions as well. And we'd love for you to follow us on social media, LinkedIn, Instagram, and Facebook at breakofdaycapital.com. And with that, we're going to start taking your questions. So the first question, I'm going to let my colleague, answer this question, is what is preferred return versus non-preferred return?
Yeah, this is a very good question, and it's important to distinguish the difference between a preferred rate versus lack thereof. What that you'll often see that in private equity syndications. A preferred rate is a minimum return that the operator has to give to the limited partner, to the passive investor, before they get to participate in any profit sharing. So like a typical deal structure that you might see could be, 8% pref, 80-20 split. And what that means is what to the extent that there are profits to be distributed from the deal, the investors will get they'll get the first 8%. For the It's 8% per year. And it's accrued if it's not paid out in that year. So let's say it's on a 3-year hold. If the preferred is 8%, then you would have to get a 24% return, total 24% return before the operator can participate in the profit split, which is that 80-20 piece. In that scenario, the 80 means the uh, the limited partner will get the remaining 80% of the profits after the 8% preferred, and then the operator will get the 20%. Okay. Um, and it's important to note that preferred rate is not a guarantee. There are no guarantees in investing. Um, but what it is that it's a priority. Uh, the operator has to provide that first to the investor before they get to participate. And if you don't, if you see a deal where there's no preferred, like I've seen that um, as well. Those are just I think they're called like straight equity split. So let's just say whatever profits there are, we'll split it, 85-15, meaning the investors gets 85% of the profits and then the operator gets 15%. The downside to a deal that doesn't have a preferred rate is that um, if the deal is underperforming, then the operator still gets a piece of the cut or gets a piece of the profit, which my personal opinion as someone who's invested in close to 60 deals, that, that is not a good structure. You want to make sure that your investors are taken care of first before you get a piece of the pie. And there are certainly deals out there that don't have these preferreds, and I probably generally won't invest in those.
Excellent. Yeah, the next question, this is one, Joe, I'll answer since I've been asked this many times and just know it off the top of my head. Um, if I invest $100,000 in the preferred income fund, how much can I expect to be distributed to me every month? So your $100,000 investment, you'll get an $8,000 return. If you divide that by 12, your monthly return would be $667.
Adam, I might want to add that the investor can elect the option of rather than taking the distribution out of their investment, they can leave it in there and compound the distribution, and it compounds monthly because it's paid monthly. You will actually net 8.3% annually instead of 8%. So just for those people that don't necessarily need the cash flow, but would just like to re re reinvest the uh, distribution, so to speak.
Absolutely, that's an excellent option too for people. The next question, I think, Joe, you should take this one,
Sure.
is what is generating the money for the income fund?
Yeah, this is a great question. So I want to make 2 points here. First of all, something that Adam covered earlier is that when you see returns, when you see distributions that are early and consistent, that might not be a good thing for a value add deal. Well, this fund does exactly that, right? You come in this month and you'll start getting distributions next month. And it's consistent. You are expecting to receive uh the monthly distributions based on the 8% annualized return, net of all fees. How is that possible? Well, this income fund is in a special tranche of the common equity. Uh, sorry, let me rephrase that. It's in a special tranche in the equity portion of the capital stack where you get priority to the cash flows from the rental income. Also, the return of capital when there is a liquidation, when we sell the property, when there's a liquidation event. Okay. And because the preferred equity portion of the capital stack is usually limited to a small amount, we make sure that there's plenty of cash flow from operations, not from reserves, but from operations, that there's enough to pay the preferred equity investors their monthly distribution. And that's how that works. And I think I just gave you the answer to your question, which is that the the distributions is coming from the rental income.
Yeah, this next question, Joe, I'll answer this one. I get asked this quite a bit when I speak to investors, is If you invest in the new fund and the preferred income fund, and then a new deal comes around, can the money from the fund be applied to the new deal? Great question, and the answer is yes. If you do have money in the preferred income fund and we announce a new deal, you can opt to take your money from the preferred income fund and put it into the next deal um, directly. So that is an option for people who have money in the preferred income fund.
One point I like to make before we'll just wait a few more minutes in case there's any more questions. But one important point I like to make about the preferred income fund is this. Because the income, the distribution is coming from rental income, it is considered passive income. And therefore, if you have any kind of passive loss, whether you're taking depreciation from, if you have a rental property, a lot of people have a couple of single family rentals. If you're taking depreciation, and you really should, because if you don't, the IRS is going to make you pay it back anyway. So you might as well go ahead and take your depreciation. Or if you've invested in one of our syndications, or maybe you have an investment in our impact fund that gives you depreciation, well, that depreciation can be used to offset the distributions from the income fund. So it can be sheltered by depreciation for anybody. You don't have to be a real estate professional. This is for anybody.
Yeah, that's an excellent point, Joe. And that's something too that I think is very important for investors to know is, especially if you have money right now, if you want to invest in real estate and you have money right now that's just sitting in the bank, getting that, 4 or 5%, this is just a much superior option that you can put money into this fund to get a higher rate. And people often forget is money in your bank that is taxed an ordinary income tax rate as well. So this is not just you get a superior return, that as you mentioned, there's tax benefits if you do invest in a deal that has bonus depreciation in the future, or if you already have depreciation, you can use that to offset that, which I think is an incredible opportunity for investors. We have another question. Jim, I'll think you should take this one.
Sure. Well,
What kind
before I
of,
answer the question about the tax forms, I want to add one more point, or maybe just kind of piggyback what you just said, Adam, which is that one of the sources of inspiration for creating this product, this preferred income fund, is that I'm involved in a lot of accredited investor groups, and one of the things that we've been racking our brains around, over the years is where the heck are we going to park our liquidity while waiting for the next deal, right? And there is just, there's just really not much of anything like this out there. You can, maybe earn a 9-10% return on a debt fund, but it's not liquid. You're basically tied up for, anywhere from 2 years to 3 years. Um, and if you want liquidity, I mean, right now, the best thing that you can get is a money market fund, maybe paying, high fours, low fives. We we all but we already know that as soon as the Fed starts cutting interest rates, whether it's later this year or a lot next year, that rate's gonna go down with it. So next thing you know, you're gonna be seeing 2.5, 3% interest rate on your money market. So, you know, I think being able to offer investors an 8% yield with 45-day liquidity, I mean, that's pretty amazing. Whether you just have a lot of extra cash, you're waiting for the next deal, or you want to earn a very good return that can be tax sheltered, by the way. Um, and having access to your money, should you need it for an emergency, so that's just something really cool to have. I just noticed that before I answer the question about the 1099, Bruce Johnson just asked if that 45-day return is in writing. And yes, absolutely. It's in the PPM. So there are a couple of other conditions. We don't want people treating this like their personal checking account. So they are just make sure you read the PPM for the fine print. But yes, generally speaking, if you need your capital back, you can have it back with the 45-day notice to a written notice to us. And there's no volatility in the price either, right? So $100,000 in, $100,000 out. This is not like sticking your money in the public REIT where, excuse me, um, you're subject to market volatility. Um,
Yeah, the only thing I'd add to that, Joe, to Bruce's question is, yes, the 45 day, it is, we do have that in the private placement memorandum, but it's after, the only requirement is your money has to be in the fund for 90 days. That is just the one sticking point I'll just mention to you when it comes to, as Joe said, we're not trying to keep it like a personal bank, so that's the only requirement we do have.
so after when your money comes in, you will get distributions the following month. But that capital has to season for 90 days before you could start taking advantage of the 45-day redemption notice. Again, our lawyers just made us put all this stuff in there so that people don't start using this like their checking account. It becomes an accounting nightmare. Um, okay, is that good enough, Adam?
Yeah,
Let
that's
me
great.
let
I
me
know
answer
there's,
the other question. So our syndications, our funds are structured as a pass-through entity. And that means that you as a shareholder, or you as a equity owner, you are a member of the pass-through entity. And with that kind of setup, you will get a K1, a schedule, what is it, a 1065, commonly referred to as a K1. So it's a partnership uh, um, tax return. And our accountants will put it all together for you. And at the end of the year, you'll get it and you just submit it to your CPA. So no, it's not the 1099 nor or 1098. I don't see any more questions, Adam. I don't know if
yeah,
there's
yeah,
if there's
people,
any
I was gonna say,
comments you want to make or
yeah, don't be shy, please. Any questions you have, we're here to answer them. But if you do want to as I said, talk, and additionally, as Joe and I are both here, we love talking to investors, as we said. Just reminder, our emails, joseph@breakofdaycapital.com or adam@breakofdaycapital.com. We're here to I talk to investors throughout the day, so please, at any point, you can email me, or as I said, call or text me at the number right there on your screen, 602-529-2056. And we're here to answer your questions. So if anything has not been answered tonight, or if you go after the conclusion, you say, "Oh, wait a minute, I should have asked him this." Just please reach out to us. This is what we're here to do.
and this webinar is being recorded, so it will go out to people who already registered.
Okay, so we just, a new question just did come in from Steve.
Okay.
Is the preferred income fund 8%, a 1099, and the syndication a K1?
Yeah, good question. No, both our syndications, the impact fund, as well as the income fund. So we have three different products. They all get a Schedule K1. And the reason why it's not getting a 1099 or it just I think I mentioned I explained it previously that because it's a pass-through entity and basically it's a partnership and that's you're gonna get a K1. Um, okay, we have another question. I'll go ahead and read this, Adam. Does does a LP get benefit from asset depreciation? Yeah, so um this is something that I was trying to explain earlier is that Our preferred income fund, which is the fund that Adam mentioned earlier, you do not receive depreciation from this particular fund, the income fund. However, because the income is coming from rental real estate, you can use depreciation against that income. Now, that depreciation can come from your own rental properties. It can come from one of our syndications that you may have already invested in, or a future syndication that you may be interested in investing in, or in our in our impact fund, where we already have, one deal and we're gonna buy a couple more, and we're giving investors depreciation out of that fund. You can use depreciations from other sources to offset the income from the income fund.
Yeah, the next question, I think it's a great continuation of just these questions about taxes. Comes from Bill. Can returns from other investments be invested with you before I pay income tax on the previous return?
You want me to take that one, Adam?
Yes, you're rolling with
Yeah,
the
so
question, so I
this
thought
is a
I'd.
great question, Bill. So I'm not sure if you were on the entire presentation, but in an earlier myth, I mentioned that we employ something called a lazy 1031, and which is that as long as you do all of this within the same taxable year, let's say you exit a deal in January 2024 and you have capital gains tax, and which you will be paying for next year, right? As long as you invest enough proceeds into a future deal in the same taxable year in 2024, and let's say you did that in December of this year, right? Let's say you invested in one of our deals and you get a 60% bonus depreciation. That means that for every $100,000 that you invest, we're gonna give you a 60% write-off, $60,000 write-off. And that might just be enough to offset the gains that you've already triggered. Okay. But again, because this is not a traditional 1031 where you have to identify the exchange property within 45 days and you've got 180 days to close. Doing it this way, the lazy 1031 way, you have a whole year. As long as it's got 2024 in front of it, you're good to go. Hopefully that answers the question. That's a that's a really good question.
Yeah, these have been
And
excellent
that's the
questions
beauty.
about the tax benefits.
Yeah, that's the beauty of a 1031 exchange, is that you have a lot more time to execute on the exchange.
Mhm. Yeah, it's interesting that you talk about that, Joe, too. The lazy 1031 versus the 1031 is I've actually talked to numerous investors who, so, a lot of people were actually are not too familiar with the lazy 1031. That and they've said to me, like, a lot of people have inquired of me, hey, can you 1031 into one of your deals? And I said, well, are you familiar with the lazy 1031? And they actually had not been. But, once it was explained to them, said, oh, wow, that's, as you said, there's no, 45 days to identify a property, hope it closes within 180 days. That just gives them a lot more leeway and a lot more, less stress. And as you mentioned too, is, when I was a multifamily realtor, I worked with a couple people who were in a 1031 exchange, and those can be nightmares. In one case, it did work out well because I knew some off-market properties, but the other case, the buyer got stuck with a property he still really doesn't like. He kind of got, was forced to make a acquisition he didn't love. So this is just a much better, opportunity, I believe, that lazy 1031 option where people can get a lot more upside with their returns.
Yeah. I mean, it's funny, Adam, like how often, when we're selling a deal, we would always love to have a 1031 exchange buyer on the other end, because those
Yes.
guys, they're under the gun, so they'll pay anything.
Oh, yes.
So anyway, the point being is don't beat that guy, don't be that guy. Like don't that's the wrong side of the trade.
Great. So here's another question inquiring about 1031s from Hannah. For the lazy 1031, 1030 or 1031 exchange, do the funds need to be invested within 1 year or within the same calendar year?
Yeah, hey, hi
Great
Hannah.
question.
Uh this is a good question. So it has to be in the same taxable year. So, when you're gonna pay 2024 taxes in 2025. So all that activity has to happen in 2024. So it's not simply 12 months. It's not the length of the year. It has to be in the same taxable year. So, once again, if you sold something in February 2024, you need to reinvest that capital before 2024 runs out. Yeah, and Adam, also I think it's worth mentioning that using this lazy 1031 method, this this strategy is available for everybody. It's not limited to only real estate professionals. This is um you can use passive losses, which is what depreciation expense is. You can use passive losses against passive income.
Absolutely too. And it's not just applied to commercial real estate too, is many people who've actually invested with us. They had sold a rental home. They had sold like a single family residency that was used as a rental, an Airbnb, something like that too in many cases. And use that the lazy 1031 to invest with us to avoid the capital gains tax.
And this is something, there's a lot of nuances to this kind of stuff. So this is where Adam and I come in. If you have a personal situation or if you want to just learn more about how this stuff works, we live and breathe this stuff because I mean, I'm an investor myself, so I'm always finding ways to offset income so that, you know, we could keep kicking the can down the road, so to speak. There's another question, Adam. What's the next project? You want to take that one or?
Sure. So the next project, we right now we're as you said we're in between deals right now. We underwrite numerous deals throughout the week and in the month. Whenever a deal is presented to us, we do the underwriting. Look at the asset management, the upside. But one thing that I think really one of the reasons why I love working for Break of Day Capital is, I met Gary, 4 years before I joined the team. And I showed him as a realtor numerous projects along the way, and he turned them all down. And one of them I actually thought was quite good, but uh, Gary and our team here, extreme discipline. That we need to see something that really checks the boxes. And for us is, we talk about that 40% NOI boost the first year. That is an incredible number. And what I think is more impressive is not just that's impressive that's been accomplished one time. That's been accomplished for 9 consecutive deals, and most likely 10 because Spanish Trail so far is doing better than expected. So as I said, we have extreme patience. We're waiting for the next opportunity to come along, but we are consistently looking at options. And when the right one comes along, we will definitely submit an offer, which is hopefully accepted, and take it from there.
Um, got a question from Paul Hamilton. This is a really good one.
Yeah.
Let me reread his question.
Mhm.
So from Paul, so is there a downside on the lazy 1031? As long as done in the same calendar year, it seems to have the same outcome. When finally selling the new property some years later, that accelerated depreciation will be recaptured or just moved to another 1031 or lazy 1031 until our estate is finally passed to heirs at a stepped up cost basis. Does this make sense? Yes, absolutely, Paul. That's exactly that's the next step, right? So here we're saying if you sell a deal in 2024, and then you reinvest in another deal in 2024, the same taxable year, you've got the tax situation mitigated, right? Now, fast forward 5 more years, the new deal that you got into 2024, now you go to sell it in 2029, you'll, as long as you keep doing the same thing, hopefully we'll still have bonus depreciation in 2029. The Congress is talking about reinstating it, uh, retroactive 2023, 2024, 2025, actually to the remainder of the period. So if that's the case, then you can write off potentially up to 100% of your reinvestment. But let's fast forward to 2029 and see what happens. In 2029, the new deal that you invest into this year, um, you'll trigger capital gains. You'll also have the depreciation recapture. Okay. Once again, as long as you take those proceeds and invest in the new deal in 2029, you will just be able to keep kicking the can down the road. Where it could get a little tricky is if we don't have bonus depreciation in 2029, we can still use accelerated depreciation via cost segregation study. So you'll still get something. You'll still be able to defer, a good chunk of it. Again, as long as you reinvest enough, as long as you can generate enough accelerated depreciation on a future deal, you can then work backwards and decide, you can figure out how much you need to invest in order to shelter your uh the deal that you're exiting, the capital gains tax triggered, the depreciation recapture tax triggered. And yes, finally, the ultimate goal, I'm sure we've all heard, swap till you drop, right? So yeah, you can keep swapping via the lazy 1031. And then once you pass your assets down to the heirs, and they'll get the stepped up cost basis and basically be able to sell everything, tax free. Yeah, that's a really good question.
We'll give it one more minute to see if anybody else has one more question. But thank you everybody who participated tonight. These, Joe and I really enjoy doing these webinars, and we also really, and what makes it fun too is when people participate, ask us great questions. So thank you, everybody participated tonight. And a reminder too, as we said, if there was anything that was not addressed tonight you'd like to talk about, definitely feel free to email Joe or myself. We're here to take your questions. My number there is, again, you can call or text me at that number anytime. So please do. Love to set up a call to discuss our options with you. We do have one question that just came in. Joe, I'll let you take this one. This is a pretty interesting one about having to do with tax benefits for
Yeah,
professional real estate investors.
this is literally a topic that is so near and dear to me, and we have these internal discussions all the time because members of this team are uh, uh, real estate professionals, so they're able to take significant advantages. Essentially, the way to think about it is, well, first of all, what is a real estate professional, right? It's somebody whose primary trade, whose profession is in real estate. And the IRS is very strict on this. You have to meet several conditions. You have to perform at least 750 hours per year managing your rental real estate. You have to spend more than 50% of your time doing it, right? So you can't be a genius doctor and then still claim yourself as a real estate professional. That will trigger a red flag, or that will trigger an audit pretty quickly. Um, you'll also have to document all your hours worked, the task, the activity, um, highly detailed. And they have to be there's also a restriction on the activity that is counted towards those 750 hours. So literally, you need to actively manage the properties, like checking out prospective properties, hanging out with us on the webinar doesn't count. Going to real estate conferences, going to investor dinners doesn't count. You literally have to be actively managing the properties that you own. Okay, whether it's a syndication, a fund, or single family rentals that you have. Okay, so if you qualify for all that, then you can what the benefit that's available to you is that all of your depreciation can be used to offset all of your income. Okay, so that no longer does the IRS distinguish between passive or active. Okay, so literally, if all of your depreciation from real estate can be used to offset whatever income you have, W2, from 1099, and other investments, other businesses. Um, One way to do this, another way that counts is if you're a professional wage earner, you're a doctor, lawyer, engineer, whatever, and your wife is the real estate professional, then if you file your tax returns jointly, then you can use her real estate professional status and benefits that come with that, and use that to offset your W-2 or 1099 or business income. Okay, so that's another way to do it. Now, that is very difficult to qualify for. Rep status is very difficult to achieve, and unless you really can support that claim, don't do it because it's very likely that you'll get an audit, and they will turn you up, they will turn your financials upside down. So it's really not worth it. Having said all that, there's still a lot of benefits that are available, tax benefits available to non-real estate professionals. And this is where the concept of active and passive buckets come in. Real estate rental activities consider passive activity, even if you manage it yourself, even if you spend all your time doing it. Um, you can you can still use depreciation against passive income. You cannot use it against active income. Okay. So if you collect any consulting, revenues, or you have a part-time job, you cannot use depreciation to offset that. But you can use depreciation, passive loss, against other passive types of income, such as um, interest that you receive from a savings account, dividends or interest payments that you receive from holding bonds, and obviously rental income, capital gains from other types of real estate, whether it's your own personal direct ownership or via a syndication like ours or via the impact fund like ours. You can use passive loss depreciation against those kind of income. And then I would just add one more thing. Passive loss cannot be used to offset portfolio income. That is a special category that the IRS um, classifies like dividends, capital gains from stocks, ETFs, and mutual funds. Even though that's pretty passive, like that is the one category that the IRS doesn't want you to they won't let you use depreciation to offset those kind of gains. Only passive gains, primarily real estate.
And
Okay.
Joe, related to that last question, another question just came in, which I think you should take, just piggyback on what everything you just said. Can tax depreciation offset a real estate capital gain?
I'm gonna rephrase this question just to make sure that it's 100% clear. You can take depreciation from real estate to offset um, cash flow or capital gains from a sale of a real estate. Okay. So you sold your property, you made $100,000. That capital gains can be offset by depreciation from another investment, from another real estate investment. And then there's a question. So Amish, let me know if that's clear enough. If not, I can explain some more. Um, there was a question about if we're gonna do a webinar on bonus depreciation benefits, and then those that don't have rep status. So this is a great question. I feel like this person's in like reading my mind. I don't know if it's gonna be Adam or me, or maybe it might be one of my other esteemed colleagues. We're gonna be presenting on using we'll take a deeper dive in using tax benefits for non-real estate professionals because we have a lot of investors who are not real estate professionals, and we want to make sure that they are aware of all available tools to use depreciation and how to use it.
Yeah, one question just came in just about our our webpage. It says, I found a download on the webpage. Is that the free book? No, the you cannot download the book on the webpage, but on our webpage there should be a spot where you can order the book. As I said, it's free, just have to pay for shipping. So that's one way but what you downloaded, that's not the book. The book's about probably about 120 pages, Joe. Would that be my best guess?
Yeah.
The book
So
is.
Paul, I don't know if I hope that you're let me just say that Gary's book, Best in Class, is very much focused on asset management. So this is he really wrote this book for other operators, for syndicators, for real estate investors. And what it is it's he gets into the nitty gritty details about basically how to manage your assets. You know, all the different KPIs that he tracks, the tools that he uses, the things that he's concerned about, a lot of the skills in managing your property manager. So it's a little niche. It's a little bit of a specialty item. So uh, if that's what you want, then you can even search on Amazon. Or what was that site? Or maybe, Paul, if you want to email us, we can send you the site, or you can search for it
Sure.
on the website. But it's Best in Class. And maybe yeah, okay, maybe I shouldn't say anything. I was gonna say we have another book coming out for the passive investor, but I've already said too much.
Cat's out of the bag.
Oh yeah. So so that's what I was trying to allude to, Paul. Paul was saying that he's more interested in the insider tips and tricks. So um that might be the next book that will be released soon. And that's going to really help the passive investor in evaluating sponsors and that kind of stuff, right? Would you say, Adam?
Yes. Yeah, that's a good description of the next book.
Okay. Have we done it?
I think so.
Oh,
Yes. So Paul, just if you want to find the book, if you on our webpage, if you look at all the, click downs, there should be one that says investor tools. And on that, under that, you should be able to find the book. There should be like an order the book on the bottom. Under that, under investor tools is where you should be able to order the book.
Well, before we sign off, I just want to thank everyone that, took some time out of their busy schedule to be with us. I go to a lot of conferences, in all types of industries, and a lot of those time, a lot of times it's on a Saturday or Sunday morning, and usually the presenter is always, congratulating the attendees because it's like people who take the extra effort, the take the time and effort to really learn about something that's outside of your conventional norm, outside of the stocks and bonds and whatnot, So yeah, I kind of want to return that favor and just thank you for taking the time to be with us and with your interest to learn about, alternative investments and particularly private equity real estate.
Yeah, I want to echo what Joe said too. Is we're very grateful for our attendees tonight. Thank you for the fantastic questions. We got a lot of compliments too in the Q&A. People saying great webinar. Thank you. So thank you guys. And as I said, please at any time you have a question or any feel free to reach out to us. But we do have one more question coming in here right now that I'll read the question. I think Joe, you should answer this.
Yeah, let
I
me
was
read this for the
Yeah,
benefit of
you
everybody
go ahead and read
else.
it. Sure.
Yeah. So Paul says he was an LP in syndication from 2018 to 2021, and he basically just broke even. And the implication there is that, those were very incredible growth years. And, it's almost like, I've heard people say like, oh, you can be an idiot and make money in that market. And still there were people who didn't. Um, and so this is something that I can definitely resonate with, because I have certainly invested in deals that went through that same period and actually lost money. So again, this goes back to the operator, you, you know, before you even look at the numbers on the deal, the projected returns, and, before you even assess the deal itself, you really need to get to know the operator really well. The things that you want to look for. And I think a lot of the things that you can learn from, for your benefit of evaluating sponsors and deals, is it'll be in the next book that we're going to release. And you basically just need to invest with the right operator. Um, and just a few quick tips. You want to look for operators that have a good track record, have a history of success, that is specialized in just a couple markets. You cannot possibly know a lot about every market around the country. Excuse me. Real estate is super, super localized. Like, we know the streets of Tucson and Phoenix, very well. Um, you also want to look for skin in the game, make sure that the operator has a lot more to lose than you ever will. And so when all when the interests are aligned, and you can assess their character, and that'll give you a better probability of success. There are no guarantees in this business, but if you bet on the right jockey, you should do really well overall.
Yeah, Paul too is one, and anybody else is not just directed to Paul, but anybody. Joe and I did actually a podcast with Gary specifically about vetting the operator and what to look for in the sponsor. So, I was telling you about checking out some of Gary Lipsky's podcast. That's one that you can definitely check out. And we also did a webinar on it too. That I either if you send me an email, I can definitely send it to you, the link to that webinar about vetting the operator. But it's also available on YouTube as well, so you can search it. But if you send me an email tomorrow, I'll gladly send you the links to both the podcast and the webinar we did about vetting the operator and what to look for in a sponsor. So I think that's it, Joe. Again, if any questions were not answered tonight that you think about, feel free to reach out to us. But again, Joe and I want to thank you tremendously for participating in our webinar tonight. We will have upcoming ones. We hinted towards what our next one's going to be. So we'll keep you informed about that. But thanks once again. If anything else arises, feel free to either call me or send me an email. I'll gladly answer additional questions or to set up a discovery call.
Thanks, everyone. Have a great night.
Thank you.